Unveiling the AI Bubble. How China's DeepSeek outperforms the U.S. stock market. China's DeepSeek has outmaneuvered the U.S. stock market. This move unfolded as anticipated, though the unexpected twist, the proverbial bloody dagger, came from China. What does this signify? When Trump assumed power, a black swan event linked to DeepSeek emerged. After a year of explosive growth, U.S. tech stocks crashed overnight, wiping out $1 trillion in value. What does this imply? Each year, the interest on U.S. debt alone amounts to roughly $1 trillion. Currently, the U.S. Treasury holds only about $700 billion, meaning available funds fall short of even covering the annual interest payments. Now, with U.S. stocks losing another $1 trillion overnight, equivalent to the entire interest shortfall, what does evaporation mean here? Does it suggest the money simply vanishes without a trace? If so, where did it go? U.S. stocks plummeted, yet signs of recovery soon followed. Is this a chance to buy the dip, or merely the opening act of a broader financial collapse? Greetings from FortuneCraft. Ladies and gentlemen, what game are we playing here? Is it a trading game? Consider this. Today I'm trading 2 pieces of paper for your Ferrari. I'm driving away, and you're left losing money. Right? Of course, we're not directly swapping papers for Ferraris. Instead, I sell those papers for $1 million and use that to buy your Ferrari. In essence, a country operates like a company. The more goods it sells, the more value it can reclaim. Yet, last year the U.S. trade deficit neared $1 trillion, meaning the U.S. spent more on imports than it earned from exports. Does this indicate the U.S. has been losing money? If you relied solely on economic logic and had never visited the U.S., you might conclude the country is poor because it spends more than it earns annually. But that's not entirely true. The U.S. remains the world's largest economy. Why? Because it doesn't just sell goods. It sells 2 pieces of paper, U.S. stocks and government bonds. This is the essence of finance. 50 years ago, over 20% of U.S. income stemmed from manufacturing. For instance, out of $100 billion earned, at least $20 billion came from selling planes, cars, and other goods abroad. Earnings from tangible labor. Last year, however, manufacturing accounted for only about 10% of U.S. GDP. The U.S. no longer relies on manual labor for income. Factories have shuttered. Why? Whether it's a company or a country, what matters isn't how much is earned or spent, but how value is assessed. Take Elon Musk's fortune. We gauge it by the value of his Tesla stock, not the cash he's personally earned. If he sold that stock, how much would it fetch? The same logic applies to his cash reserves. We don't focus on his company's profits, but on how much he can borrow. So, does the U.S. trade deficit matter if it spends more than it earns? Not necessarily. Because the U.S. isn't selling goods, it's selling those 2 pieces of paper, stocks and bonds. Take Nvidia, for example. It earned less than $100 billion last year, yet its stock price surged 9-fold over the past 2 years, creating a $3 trillion valuation. What goods did the U.S. sell to generate $3 trillion in just 2 years? Meanwhile, the U.S. Treasury struggles to pay interest on its $36 trillion debt, borrowed from around the world. How much tax revenue would the U.S. need to cover this? A few years ago, when the U.S. raised interest rates, money flooded in from across the globe. Now, however, U.S. bonds are harder to sell, even as U.S. stocks climb. What does this mean? It suggests money is flowing into the pockets of capitalists via the stock market, not into the U.S. government's coffers. This crash, driven by U.S. tech stocks, has led many to point to China's DeepSeek as the culprit. Concerns have arisen that China's AI growth might match or even surpass that of the U.S. But DeepSeek was unveiled in May of last year. Why is it only being discussed now? Interestingly, our attention wasn't sparked by TikTok or Facebook, but by statements from American tech titans like Mark Zuckerberg and others, with media coverage erupting simultaneously. What does this suggest? Figures like Warren Buffett, Bill Gates, Zuckerberg, and other prominent players quietly sold their stocks last year. What do they see on the horizon? If you want to safeguard the money you've worked so hard to earn, avoid being a pawn or victim in this game, and even seize opportunities to grow your wealth beyond financial constraints. Follow my channel. I'll share more insights in the future. Worried that listening and forgetting might waste your time? Save this video to your playlist. It'll be there whenever you need to revisit it. First, let's explore how U.S. tech giants view DeepSeek. They call it fake, criticize its quality, and claim its production costs are too low. Yet they don't dispute its capabilities. In the consumer market, a cheap counterfeit designer bag might signal a boycott. But this is the capital market. Investors don't care about authenticity. They care about who's developing technology that can rival the U.S. Tech giants haven't denied DeepSeek's potential. Some even praised it upon its debut. So why does the market, whether public sentiment toward AI or the U.S. stock market, remain consistently optimistic over the long term? Why has the U.S. stock market historically trended upward, despite last year's dramatic swings? Centuries ago, our ancestors were farmers, toiling with simple tools. Then Britain invented the steam engine, sparking the first industrial revolution and shifting labor from fields to factories. By monopolizing steam technology, Britain enforced colonial policies worldwide, becoming a global hegemon. While others rode carriages, the British traveled by train or ship. In a war, how could you compete without that technology? Later, the US and Germany launched the Second Industrial Revolution with electricity and oil. Before the light bulb, work ceased at dusk. Afterward, people worked into the night and embraced nightlife. Appliances, cars, and telegraphs accelerated communication, propelling the US and Germany past Britain. Then spearheaded the Third Industrial Revolution with computers and the Internet, cementing its status as the world's dominant power. Here's the pattern. The first country to complete an industrial revolution monopolizes that industry and transforms its economy. People moved from fields to factories, then to offices. If your nation remains agrarian while others work in offices, your economy lags far behind in military, education, and finance too. This is why U.S. stocks grow long-term. Through industrial revolutions, America has monopolized technology, education, military might, and finance. As a capitalist, would you invest in the U.S. or Africa? This logic drives the sky-high prices of U.S. bonds and stocks, enticing global investors to profit and making U.S. assets the top choice. Some argue that, as non-Americans, they should invest locally. But is that necessary? If you have $10,000 to invest, you could choose U.S. stocks, yet many don't. Living in Africa doesn't mean you must invest in African stocks. Local markets might be familiar, but the priority should be U.S. stocks due to their higher success potential. If your country restricts U.S. stock investments, Domestic options become the default, though technology can eventually catch up. Britain, once ruled as the sun never sets empire, a colonial giant, that dominance has since passed to the US, which completed industrial revolutions ahead of others. If China leads the fourth industrial revolution, driven by AI, US stocks and bonds could falter as capital flows to China. To keep selling its financial instruments, the US must innovate, leading the AI revolution and fortifying its defenses in this field. Within 5 to 10 years, autonomous vehicles could replace human drivers, and robots might heal the sick. Jobs will shift dramatically. If the AI revolution succeeds, it'll mirror the leap from farming to factories, upending the global economy. Imagine a war where one side deploys robots while the other uses humans. Destroyed robots require no pensions, reshaping power dynamics. Are you intimidated, tempted to dive into AI development? This is the narrative being sold, the fourth industrial revolution as the AI revolution, likely led by the US due to its robust advantages. The most advanced AI models, like those from OpenAI and Google, are American. Developing them requires vast data, materials, and crucially, graphics cards from US firms like NVIDIA and AMD. To compete in AI, you need deep pockets for cards, models, and soaring electricity bills, resources only giants like Microsoft or Meta can muster. Yet AI isn't just about money. If China pursues AI but lacks US graphics cards due to export restrictions, its progress slows. This is America's edge. Only the USA's and China are serious contenders, with the US leading by 5 to 10 years. Why do investors flock to US AI firms despite annual losses? $1 billion invested might yield an $80 billion loss. This year, $50 billion might lose $13, yet investment persists, stopping risks, squandering prior bets. OpenAI exemplifies this, backed by US funding. It signals America's capacity to lead the AI revolution. Global money pours in, letting US firms raise capital cheaply to advance AI, especially in chips. NVIDIA and AMD soar as investors chase the gold rush of graphics cards, echoing tool sellers, profiting during past booms. Who benefits, and how will this revolution conclude? We'll only know in hindsight, as small investors lag behind the elite. Suddenly, US tech giants are downplaying their own lead, claiming DeepSeek narrows America's AI edge to 3 to 5 months ahead of China. Why? DeepSeek, akin to ChatGPT, was developed in China for $500 million versus $10 billion for comparable US models without heavy reliance on US chips. It's now free and open source, meaning anyone can replicate it with minimal investment. 2 affordable GPUs instead of massive data centers. GPT charges $200 monthly. DeepSeek offers similar functions for nearly nothing. This slashes the AI development barrier, disrupting the US model of costly proprietary systems. Imagine spending your savings on a proposal ring, only to see identical rings handed out free nearby. Investors who poured billions into US AI now face a similar shock. DeepSeek devalues their stake. Curiously, US tech giants are amplifying this narrative. Didn't they foresee stocks tanking When this went public, DeepSeek emerged last year, yet only now grabs headlines. Sparked not by internet buzz, but by these leaders. Last year, Zuckerberg, Gates, Huang, Bezos, and Buffett quietly sold stocks. Why broadcast a rival's rise? Unless it's madness or strategy. If you sell at $100, watch it drop to $80, then buy back, you've netted $20. Could this be orchestrated? By framing DeepSeek as a threat, they might draw more global capital to the US and betting on its resilience. Investors, having sunk so much into US, may double down rather than abandon ship, like waiting for a late bus, fearing it's just moments away. DeepSeek suggests China's AI is close, perhaps 3 to 5 months behind. Has China surpassed the US? Not yet clear. This volatility might not pop the US stock bubble. It could even lure more capital as the US rallies allies against China, accelerating its AI edge. If the Federal Reserve hikes rates instead of cutting, stocks could surge further. With rate cuts paused and bonds harder to sell, how the US navigates this and where stocks head next remains uncertain. I'll pause here due to time. We share free insights on entrepreneurship, investing, and financial freedom. Subscribe, enable notifications, and share this video to stay in the loop. Your support could make this one of the few videos to transform your life. I'm FortuneCraft. Thank you for watching. Goodbye.